Welcome back as we go into some examples of corporate restructuring actions and how to evaluate them. We'll go through examples of evaluation of investment actions, divestment actions, and restructuring. Let's dive right in. We'll start with an equity investment example. Legacy Motors is a US-based car manufacturer with a long history and has sales in several markets all over the world. It is a mature company with slowing sales growth as the world makes its shift towards electric vehicles. Although the company has made an effort to introduce electric versions of its flagship cars, sales have been poor as consumers veer towards the new entrants in the electric vehicle market with futuristic designs. One such company is a new entrant called Next-Gen Motors, which has long wait lists for its futuristic cars with self-driving capabilities. However, as the company is focused on growing market share, it has never turned a profit. It is still expected to make a loss in the following year. Legacy is interested to acquire a 40% stake in Next-Gen for $3.2 billion to have a firmer foot in this fast-growing EV market. The entire amount will be debt-financed at an interest rate of 7%. It is proposing to add Next-Gen cars to its global network of distributors, which will help accelerate the company into profitability. Next-Gen is happy to receive the investment, as it needs the cash to grow its market share and further its R&D efforts into driverless technologies. It also believes that tapping the distribution network of Legacy will be beneficial. Let's study if the proposed $3.2 billion investment for 40% equity is reasonable. Given that there are 3 comparable electric vehicle brands with the following enterprise value to sales ratios, do you think the price Legacy is paying for Next-Gen shares is reasonable? Using comparable company analysis, the average EV to sales multiple is 8.8 for the comparable companies. Since Legacy is paying $3.2 billion for 40% equity, the entire equity of Next-Gen is valued at $8 billion. Given that Next-Gen does not have any debt, and assuming the company has no cash, its enterprise value is therefore $8 billion. Given the latest revenue of $800 million, its EV to sales multiple is 10.0. This multiple seems higher than the comparables average of 8.8. It could be that Legacy is paying a premium due to the higher expected growth of Next-Gen against its peers. Legacy may also be confident that Next-Gen's growth will be further boosted when it is able to access its distribution network. Now let's model how Legacy's financials will look for 2023. If you recall from the FSA course, the equity method should be used for an investment in associate. Given we have the pre-investment estimated financial figures, we can determine the change in EBITDA and EBIT based on one-line consolidation of the net income from Next-Gen. So if a net loss of $200 million is expected, both the EBITDA and EBIT estimates of Next-Gen should be lowered by $80 million. Debt should increase by $3.2 billion as the investment is debt-financed, and given that the debt financing cost is 7%, total interest expense should increase by $224 million. After all these adjustments and assuming an effective tax rate of 30%, the net income of Legacy is estimated to be about $7.8 billion, which gives us a diluted EPS of $7.80. Undoubtedly, the EPS will be lower due to expected losses from Next-Gen and higher interest expense from taking on more debt. The company's debt to EBITDA ratio will also increase from 0.62 to 0.87. However, this is still a low leverage ratio, so it's not much of a concern. The important thing to note is Legacy clearly recognizes the future of electric vehicles, so it is keen to be more firmly entrenched in the market before its legacy products become obsolete. The firm has the financial means to fund this equity investment. Next, we shall just briefly talk about joint ventures. The process of evaluating joint ventures is very much similar to that of an equity investment. Like for this example, Legacy could be one of the parties involved in a joint venture with 40% stake to set up a new EV company. The estimation of the pro forma statements is the same as what we went through earlier, as the equity method is usually used for joint venture investments. We can likewise estimate the effects of the investment on its EPS and leverage ratios. And lastly, let's consider the case of a full acquisition of Next-Gen instead of an equity investment. We've earlier valued the equity of Next-Gen at $8 billion. However, since Legacy is seeking to take control, a takeover premium may be warranted. So let's say Legacy offers $10 billion, all financed with debt at 7% interest, to purchase 100% of Next-Gen shares. Legacy expects a revenue synergy of $300 million from Next-Gen, taking advantage of its extensive distribution network, and cost savings of $60 million for 2023 due to economies of scale. If you recall from the FSA course, the acquisition method states that all the revenues, costs, and expenses of the target are to be consolidated into the parent statements. See if you can work out the pro forma 2023 statement for Legacy after the acquisition, taking into account the $300 million revenue synergy and $60 million cost savings. First, let's add on the expected earnings from NextGen for 2023. The revenue synergy of an additional $300 million should increase revenue and earnings by this amount. The cost synergy of $60 million should increase earnings by $60 million. Remember that a reduction in cost is an increase in earnings, hence we add on the cost synergy here. Sum them up, and these are the consolidated revenue and earnings. Since Legacy is taking on $10 billion of additional debt, the additional interest at 7% is $700 million. The total interest expense is therefore $1.26 billion. Less off taxes at 30%, we get a net income of $7.63 billion, which gives us a diluted EPS of $7.63. And since total debt has increased to $18 billion, the debt-to-EBITDA ratio is expected to increase to 1.4. From this evaluation, we estimate that Legacy's revenue will increase, and if the synergies work out, the EBIT will increase marginally. The earnings per share will fall because of the much higher interest expense. Perhaps the most alarming thing is the jump in debt-to-EBITDA ratio. This could have implications on the firm's cost of capital. Next, let's study an example of a divestment action. Prima Group is a software development house with its core business in app development, a division called Prima Apps. The company has a smaller business segment called Prima Cloud, which provides cloud services to corporates. Selected financial estimates for Prima Group for the next year is given below. In particular, the segment EBIT contributions from the two divisions are given. Let's say the average forward-looking EV to EBIT multiple for app developers is 8.1 and 12.5 for cloud service providers. Given that Prima Group shares are currently trading at $30, is there a conglomerate discount based on all the information here? Well, let's first work out the enterprise value of the whole company. The equity value is $300 million based on the market price and 10 million outstanding shares. We shall use the balance sheet debt value of $60 million since there is no better information given. And since the cash balance is not given, we shall assume cash to be negligible. The group enterprise value works out to $360 million. Based on industry average forward multiple and the forecasted EBIT, Prima Apps should be valued at $307.8 million, while Prima Cloud should be $93.75 million. The sum of parts valuation for Prima Group is therefore $401.55 million. So if the market values Prima Group at $360 million, it is trading at a conglomerate discount of $41.55 million, which is a 10.3% discount. Next, let's say a buyer offers $100 million in cash to take over Prima Cloud and assumes no debt from Prima Cloud. In the past 2 years, there have been 3 similar acquisitions of cloud service providers given in this table. Determine if this is a fair price for Prima Cloud using comparable transactions analysis. First, let's determine the EV to EBIT multiples that the acquirers paid for the comparable companies. The EV paid is the sum of the cash and stock value paid, plus the debt that the acquirer assumed from the acquisition. You should get the following EV to EBIT multiples and an average of 13.5 times. So, given that the buyer is paying $100 million cash and taking no debt from Prima Cloud, and that the forward EBIT is $7.5 million, this works out to an EV to EBIT multiple of 13.3 times. This is pretty close to that of the comparable transactions, so the offer price is based on comparable transaction analysis. So let's say Prima Group decides to accept the $100 million offer. With the cash received, the company plans to immediately pay off all the $60 million debt on its balance sheet, and the remainder of $40 million is to be used to repurchase 1 million shares from the open market. Estimate the pro forma financial statements for Prima Group and work out its diluted EPS after the sale. First, the EBIT contributions from Prima Cloud will be gone, so we only have contributions from Prima Apps, which is $38 million. Debt is reduced to 0, so interest expense should be reduced to 0 since there is no more debt. And assuming the same marginal tax rate of 30%, the net income is estimated to be $26.6 million. Since 1 million shares will be repurchased, the number of outstanding shares will be reduced to 9 million. Diluted EPS will be $2.96. From this analysis, we can estimate that the diluted EPS will be higher, even though the earnings from Prima Cloud will be gone. This is due to the reduction in interest expense and the lower number of outstanding shares. This sale should make the shareholders of Prima Group pretty happy. Another consideration Prima Group management can take is to spin off Prima Cloud as a new independent company and issue shares of the new company to existing shareholders. The difference between the two is that value is realized in cash to the shareholders in the divestiture, while value is realized in new shares whose value will depend on future performance of the spin-off company. The choice between the two depends on the valuation. We have earlier determined the EV to EBIT multiple for the divestiture for $100 million is 13.3 times. If, let's say, the spin-off will value the new shares at $120 million, the EV to EBIT multiple is 16 times, so the management should go for the spin-off instead. However, the value realized from a divestiture is definitive, while the value from a spin-off will very much depend on the future share price of the new company. If investors decide they are overvalued, the share price will decrease. Last on our list is to evaluate cost and balance sheet restructuring. Unlike investments and divestments, restructuring can manifest in a wide variety. We shall illustrate the evaluation of a cost restructuring project. Connor Hospitality is a hotel chain with 100 years of history. Its shareholders have been very unhappy in recent years as the company kept to old technologies that are inefficient and labor-intensive, eroding the profitability of the company. In response, the company management have drafted a $150 million project to adopt new technologies to reduce its operating costs. The first step in evaluating cost restructuring is to compare the company's current costs against that of its peers. We do this by studying the EBIT margins. So let's say these are the revenues and EBIT of comparable hotel chains for the past year. The industry average EBIT margin is 25%. In contrast, Connor earned an EBIT of $75 million from $500 million revenue, so its EBIT margin is just 15%, much lower than the industry average. To reach the peer average EBIT margin of 25%, Connor should have an EBIT of $125 million, which means it would have to reduce its operating expenses by $50 million each year. Next, let's say the company proceeds with a $150 million cost restructuring project. We shall study how the pro forma financial statement should differ for the subsequent years. Particularly, we are interested in the EBIT, since it is the item after operating costs. We'll compare the expected EBIT if the company restructures and if it doesn't. First, we estimate the revenue for the next 4 years, forecasting an increase of 10% per year for both scenarios. If the company does not restructure, we expect the EBIT margin to remain at 15% throughout. But if the company restructures, we expect the EBIT margin to increase to 20% the following year and increase further to 25%, which is the peer average for the following 3 years. However, we expect the restructuring cost of $150 million to be expensed in the next year, so the EBIT for this year is expected to be minus $40 million. For both cases, we expect the WACC to be 12%. So, discounting all the EBIT by 12% each year, we get an NPV of $319.6 million if the restructuring goes through, and $286.8 million if it doesn't. In this evaluation, we estimate that the company should be able to recoup the $150 million restructuring cost in just 4 years. And that concludes this lesson where we went through some examples of corporate restructuring and how to evaluate them. We've also concluded this topic on corporate restructuring. Take a break and we'll see you again.